Hi, everybody. Welcome back to the Dividend Stockpile YouTube channel. Today, I'm going to talk about how I value a dividend stock. Valuation has always been an important criteria for me when making an investment. So I wanted to show the different ways that I use to find the valuation of a company before I invest. So while there are many ways to value a company, I personally use three main ones when looking at a dividend growth stock. Before we do that, please note that no single valuation method is perfect, so it's best to use a few different models and come up with a price that makes sense for you. So today I'll be detailing the following methods: discounted cash flow, dividend yield theory, and PE mean reversion. In order to do that for today's analysis, I'm going to be using Lockheed Martin, stock ticker LMT, which is a global aerospace and defense company. So the first methodology is discounted cash flow, or DCF. And this methodology calculates the current value of a stock based on what earnings you expect in the future. As you see below, the formula is quite complex, but once we break it down, you'll understand how simple and straightforward it really is. So you take the earnings per share times 1 plus the earnings growth rate, raised to the number of years in the future you want to calculate, times the average PE ratio of the stock, and divide that by 1 plus your required rate of return, raised to the number of years in the future. Again, that sounds complex, but when you really look into it, it's not that bad. So here are the inputs you're going to need to use this methodology. EPS is the earnings per share for the last 12 months. You're going to do the earnings growth rate, which is what you expect the earnings to grow in the future, or you can use analyst estimates. The number of years in the future you want to go. I always recommend 5 years in the future. It gives it enough time to balance out the growth of the company, but it's not too long that you can't forecast for. You're going to need the average PE ratio. So that's what the company's historical ratio is. And then you're going to need to determine your personal required rate of return. This is up to you, but the market in general over time has usually returned about 8 to 10% a year. So a number in that range would be more than sufficient to come up with a good valuation. So once you get all that information, and you can pull that information from the various financial websites out there like Yahoo Finance or Seeking Alpha or Guru Focus, Morningstar, places like that, you can gather this information. So looking back at Lockheed Martin, utilizing the different input criteria we need to do, the EPS is 2181, earnings growth rate, according to analysts, is 6.65% over the next 5 years. Number of years I'm looking into the future is 5. Average PE will be 19.66, and my personal required rate of return is 8%. So when we use those figures back in our formula, you can see how it's calculated. So 2181, which is the earnings per share, times 1 plus the earnings growth rate of 6.65% raised to the 5 years, multiply that by the average PE ratio of 19.66, and then divide that by our required rate of return raised to 5 years. And the final figure for Lockheed Martin using this formula is $402.65. Next, we're going to move on to the dividend yield theory. So this calculation is based on the fact that a well-established stable company will revert to the historical average dividend yield payout over time. So this one is a lot easier. So you just take the current dividend payment over the last 12 months and divide it by the historical dividend yield. So here are the inputs you're going to need: the current dividend payment in dollars and the historical dividend yield in percentage. Looking back at Lockheed Martin, the current dividend payment is $12 per year, and the historical dividend yield is 2.60%. Using these figures, we calculate the formula using 12 divided by 2.60, and that comes up with a valuation of $461.54. Let's move on to our last methodology, and that one's going to be the PE mean reversion. So like the dividend yield theory that we just completed, a quality stable company should revert to its average price to earnings over time. This formula is straightforward as well. You take the current earnings per share over the last 12 months and multiply it by the historical PE ratio. So here are the inputs you're going to need: current earnings per share for the last 12 months, as well as the historical price to earnings ratio. Looking back at Lockheed Martin, the current EPS is 2181, and the historical price to earnings ratio is 19.66. Plugging those figures into our formula, we're going to come up with a valuation of $428.78. Now that we've looked at all three methods, let's put it all together to see what valuation we can come up with. So as a recap, our discounted cash flow showed us a valuation of $402.65. The dividend yield theory came up with $461.54. And the price to earnings mean reversion came up with a price of $428.78. So since we've talked before that no single method is perfect, there's two ways you can approach the valuation. You can either estimate based on the three. So you can look somewhere in the middle and say, okay, a realistic price would be around $430 for Lockheed Martin. Another way that you can do it is average the three out. So add the three together and divide by three. And it's going to give you an estimated price. So if you look at Lockheed Martin or any other stock and you can buy it at a price that's lower than the valuation method that you've determined, then you are possibly buying it at a good value. But remember, you always have to look at the fundamentals of the company to make sure they're still intact. So I hope that helps understand how to value a dividend growth stock. And for full disclosure, I do own shares of Lockheed Martin. And additionally, this is not financial advice. I'm not a professional advisor. This analysis is for educational and informational purposes only, and stock investing involves risk. I appreciate everyone's time. If you liked what you saw here, please make sure you subscribe, hit the bell notification, and we'll see you on the next video.